My student asked to raise $200,000, but I told them they needed to raise $2 million instead. Let's break down together why. So today, let's talk a little bit more about how much to fundraise. My name is Shuo Chen. I am a former entrepreneur, now investing in entrepreneurs and teaching entrepreneurship at Stanford and Berkeley. I'm also a board member here at Decode, the largest entrepreneurship community that is co-hosted between Berkeley and Stanford students and alumni. Back to that example we mentioned at the very beginning when we were talking about the student who wanted to raise $200,000. I really wasn't trying to be dramatic by sharing that this team needs to be raising $2 million instead of $200,000. What I was really trying to do is by trying to save this team from one of the most expensive mistakes in startup life. Let me explain a little bit more. This particular group of students, they are building a startup that is an incredible opportunity. But if you look at just the core of their business, you realize that by raising $200,000, it will only cover their burn rate for about 6 months' time. Which means, by the way, burn rate means that that's how much cash they'll be churning through in order to continue to build a business for the next 6 months. And so they would very quickly start running out of cash and they would need to be back on the fundraising treadmill in just a couple of months. So if you're running out of money in 6 months, you ideally are starting fundraising, 3 to 4 months before you actually run out of money, which means you're fundraising now. And within about a month's time, you're going to have to kick off the fundraising process again. And keep in mind, every minute that founders are spending fundraising is every minute that they're not actually spending on building the core of their business. And trust me, fundraising is incredibly time consuming. You have to go out there, have tons of conversations back to back, explain what you're doing to investors, justify your assumptions, and prove that you're running the most efficient experiments possible to deliver on the best results possible. And it really is like a part-time job that somehow takes up your full-time hours. So if you're really going to go out there and fundraise, you want to do it right. You want to do it as less often and less frequent as possible. And that's why more founders are shifting their mindset. The old norm is really you want to raise enough money to last you about 18 to 24 months. So that way you have at least a core of 1 year to build heads down and not have to worry about fundraising. And hopefully in a year's time, you'll already have much more results to showcase to investors that get them excited about fueling more growth in your company. But again, that was the old norm. The new norm is that you're aiming to raise for about 3 years of runway. And what changed between old and new norm? Well, as we know, interest rates have substantially come down. And so capital is not as easily, interest rates have gone up. And so it's not as easy to raise as before when interest rates were low and people were excited to deploy capital. Now, because interest rates are high, people now have a higher opportunity cost. They can be instead investing in other things. And so the new norm truly is raising for 3 years of runway. Because why waste time on fundraising every year or two when you can truly just focus on building, scaling, and really winning? So now folks are really saying, I don't want to be fundraising every year and a half. I'm just going to fundraise enough in one go to last me 2, 3 years so that I can make a ton of progress in this time so that my business has hit a substantial next milestone before I have to go out there. And by then, I'll have numbers to prove my results and I can fundraise much more effectively in 3 years' time. Now we have to think a little bit about cost projections as well, because this is really where a lot of founders tend to mess up. Many founders tend to come to me with a detailed financial model and try to map out every single expense for the next 3 years down to every line item. And they really build it out in a way kind of like these academic classes or school startup competitions. And spoiler alert, this kind of exercise is nearly impossible because startups don't follow spreadsheets. They follow chaos most of the time in those early days. You have more unknowns than knowns. So instead, if you're trying to really build out some sort of a cost projection, have these couple of key things in mind. Number one is, what are your biggest assumptions? What experiments do you need to run in order to prove out these assumptions to be true? And so to really showcase that your business works. Well, you want to plan out for how to run these experiments. And of course, keep in mind that everything takes typically 10 times longer than you think. So you want to really make sure that you're planning in enough buffer time there. Two, you want to account for your very core costs. These are the absolute non-negotiables. These are the things like server costs. But these also could include things that you need at the basics to run. Oftentimes you'll hear this term in startup land called ramen profitability. Like, what do you need to just barely survive? You don't necessarily want to be paying yourself crazy salaries or salaries that you would be getting paid if you were to work for a big company, because we're just trying to get your startup off the ground here. But you do want to account for just the basic costs to run these basic experiments. Three, you want to really think about potential product and sales costs. So it depends on what your product strategy or what your sales strategy is. If you're product-led growth, it means your core product is good enough that someone can go online and follow through the process themselves and they can onboard themselves and understand the product. It sounds like actually a relatively cost-less strategy because you're saying people are onboarding themselves, but it actually means that you need to embed more into the design of your product so that users can onboard themselves. And you also need to carefully think about website design and constantly A/B test. Another type of product is a sales-led strategy where you're onboarding salespeople and sometimes possibly customer success people so that you can really go out there and sell your product. Of course, in the early days, it is absolutely founder-led sales, but eventually you'll need people to help you build up the momentum and close these sales faster so that you can close revenue faster. So whether your strategy is product-led or sales-led, you would need to have to think about what are the different headcount that you need to account for in order to make it successful. So you do want to think about the balance and also think about the customers you're serving. If your customers are more individuals and small, medium-sized businesses, perhaps a product-led strategy works better. But if you're selling to some of the largest companies out there, then you absolutely need sales and customer success to really make sure that you're providing a great experience for these large enterprise buyers. And of course, with accounting for all of this, we have to go back to step one, which is everything takes longer than you think it will take. So add yourself some buffer here as well. And Murphy's Law really is quite true. Everything that can go wrong will go wrong. So make sure you leave yourself some buffer space here. Now that we've talked about all of these key steps, I do want to highlight that it is incredibly difficult to fundraise. Always, whether capital is readily available or not. Even when people thought that when interest rates were low and capital was more readily available, it was still really tough to raise. So please keep in mind that you're probably raising, hey, if I raise a small amount of money, it's going to be way easier than raising a large amount. After all, it's a small amount and much smaller risk, right? Keep in mind that that's oftentimes not true for early stage startups. This might sound counterintuitive, but the truth is that asking for $200,000 is just as tough, if not possibly even harder, than asking for a larger sum like $2 million. And let me explain why. If you're in the early stages of your startup, raising a $100 or $200,000 rounds can in fact make you look like, well, you're showing up to the big boys table with pocket change. And it could be the big girls table, of course. But ultimately, people can look at you and think that you're an outsider who doesn't really know how venture capital or fundraising works. Because how is $100,000 or $200,000 going to get you substantially to that crazy next big milestone that you're trying to hit with this high growth startup? On the other hand, larger rounds like $2 million can sometimes be easier to raise because investors have oftentimes a sweet spot check size and an ownership target of your company. So if you're only asking for $200,000, investors might not even consider it seriously because it doesn't move the needle for them. If you're only asking for $200,000 and let's say in a wildly successful situation, you double that money or you even 10 times that money, well, $200,000 is only going to turn into $2 million. And that's oftentimes not enough returns for investors to really justify spending the time on doing due diligence and having this conversation with you to write that check. Many of the typical venture capital funds want to be co-investing with other investors to own, say, 10 to 30% of the startup. And if they're not getting enough ownership, or if the business is too small, they're just not interested enough because there's not enough of an upside. So you might actually be overlooked by some of the investors because you're selling too little equity when you're raising too little. Raising too much is a real challenge as well, because raising too much money can really hurt your business just as much as raising too little. It's almost like a one-way ticket to capital efficiency, and you don't want to be there. And here's why. When startups raise more money than they need, you're just sitting on a ton of idle cash. And that's money that's doing absolutely nothing except maybe earning, say, a 3, 4% interest in a high yield savings account. Meanwhile, you've just given up a substantial portion of equity in your company at the cheapest price for all that cash sitting there making interest. That is not great. You definitely do not want to be in that situation. And even worse is if all this excess cash tempts you to spend more money on things that you don't actually need. It's super easy to lose discipline and overspend because you have so much disposable cash available. I've shared this statistic over and over again, but I want to highlight when you look at the past decades of history, the most successful companies that have gone through the most successful IPOs and acquisitions, these are oftentimes companies started during relative economic downturns because that's really when startups learn how to do more with less from day one. So even if you're not in as much of a crunch time, think about how you can be more effective with every single dollar that you do raise. All in all, next time when you're thinking about potentially raising money, just remember this. It's not just about the amount you want. It's really about what your business needs to go the distance and hit that next major milestone and get to that next step milestone so that you can be thinking about what comes as success for the long term of your business. Hopefully, all of this information today helps you think about how much to be fundraising for. Thank you so much for tuning in. And if you enjoyed this session, please hit the like button and subscribe for more startup insights. And of course, if you have more questions or you got your own startup stories to share, please drop it in the comments. We're excited to hear from you. And of course, we want to learn from how you're building, what kind of questions you might have for us so that we can better help answer your questions to help you build faster and better in your startup. In the meantime, happy holidays, and we'll catch you at the next one. Thank you so much.